Fellas, you know Degree Cool Rush deodorant, right? Well, last year they changed the formula, and guys were mad about it. One dude even started a petition. So guess what? Degree heard us, admitted they messed up, and brought the original Cool Rush scent back exactly how it was. And it's in Walmart, Target, and other stores now for under $4. So grab some and remember why its cool, crisp, and fresh scent made it the #1 men's antiperspirant for the last decade. Degree Cool Rush is back, and it smells like victory for all of us.
Reality radio for a really great future. We're talking real money.
In a world where stock markets plummet, one man, okay, two, have the answer to your questions and the means by which to make it all better. This is Talking Real Money. Hi, everybody. Yeah, doing my trailer announcer voice. In a world where Tom Cock always wears a tie.
You did your trailer announcer. I'm going to do my trailer trash announcer.
Oh, well, don't you do that all the time?
Well, look at the neighborhood I live in. You could understand why. Of course.
We are starting the show off with a bit of lightness because our Saturday show and Monday podcast was we got criticized.
Yeah,
we did for being a little too heavy at the beginning, but I mean, it's so hard because I don't want to make light of the thing in Europe, that thing.
Yeah, it's bad.
I don't want to make light of that at all because it's horrible. I mean, it's really, really awful, and it has caused stock markets around the globe to do this thing over and over and over and over again.
On the podcast, they can't see that.
Oh, yeah, yeah. And if you're listening to the podcast, my hand was moving up and down like a chart.
There, thank you.
Like a chart.
Mm-hmm.
It was doing chart things. Yeah, see, I'm thinking it's a video only, but no, it's a video and it's an audio. So we have to.
I think it's actually the other way. It's an audio and it's
a video.
Okay.
More honest all right. Let's just get this out of the way before we go into the topic.
All right. Tom's complaining.
Tom, go ahead. Vent your spleen.
It should be your spleen that's on display here because yours is the one that gets hacked at to do this every week. Guys, come on, please. No, in all seriousness, we are at like 840 subscribers. That's not 840
to our YouTube channel.
That's 840. Like it's not a lot of people.
Yeah, and then we look and we see these 20-something idiots who know nothing about money.
I know. Oh.
They have no experience yet, and they get like 1 million subscribers.
How to make the easy money. Easy money. That's what we need to talk about. This show is about stocks. How to lose the easy money. Lose it fast.
All right. So let's talk about the topic at hand.
Yes. The topic at hand is what you just said.
We have seen a very volatile market. And I think right now, as we record this, we're back in S&P 500 correction territory.
We are.
Mm-hmm. Not in a full-fledged bear market.
No.
But we're in correction territory.
That's right.
Yeah. So, last week we saw correction territory and then it recovered.
Yep.
So we don't know. Back. I don't know. By the time you see this, who knows? It's all over the flipping place. So we don't know where it's going to go. We don't know where it's going to end up. But what should you do? And I know you're dying to do something. So that's why we're starting off this way. What should you be doing right now, ladies and gentlemen, in reaction to the incredible stability? What should you do when markets fall?
And so many of you already know this because I talked to so many of you, and you already know that nothing.
Okay, excuse me a minute. I got to interrupt him again. You think you talk to so many, but you don't talk to a fraction of the people who actually listen.
Well, that's true. That's true.
Now, the people who watch, you probably talk to all of them.
I call them every day. Please watch my video. Come on. What else you got to do? I got this new series on Netflix about the Vikings. Nah, this is way more interesting. Come on.
Our video is far more interesting than Vikings.
With this work, I'm halfway to Valhalla. Come on, man.
We just sit here. Instead of there's no blood or guts, we just plunder each other's egos.
That's true. Cut that. So, but what are the things actually that you can control in this situation?
That was the question.
Thank you. I mean, there's so little because there's nothing you can do about stock markets. There's nothing, well, unless you like really have a lot of money, you could buy something, I guess, and push the price up. There's really nothing you can do about bond markets. There's very little you can do about interest rates. And probably, even though you may give some sort of charitable contribution, the humanitarian need in Ukraine is greater than any one individual can probably fix very easily either. Okay, except for the Jeff or whatever. There are people that could really help, but so there's not a lot you can do about
Jeff.
all that.
I was going, who's the Jeff? Not Jefferson Davis. He's dead.
Jefferson.
Not
Davis.
Jefferson
He's
Airplane.
He's going to run
in
with a new government, Jefferson Davis.
Thomas Jefferson? No, he's gone.
Actually, he'd be helpful at this moment too.
George Jefferson? No, that series was canceled.
Oh, please. Okay, get one more Jefferson, dude. That's all you get. What is it? What's it going to be?
No, I'm not doing it.
All right.
No, okay, I just annoy you.
What are the things you can actually control? Well, number one, the thing, and this is so important because you pointed this out when we were talking about this topic prior to the podcast. You all believe that your risk tolerance is off the charts when stocks are going up.
Mm-hmm.
Oh, I feel great. I don't worry about risk. Volatility means nothing to me.
I don't even want any of those stupid bonds. Just put me 100% in stocks. I feel good about the stock market. No, not now. Until
they roil, until they fall, until we go into a correction. So this is a good time to know your risk tolerance. And regular listeners, that we have a thing called the risk quiz. This is the time to take the risk quiz, right?
Yeah, this is actually a really, really good point, Tom. The best time to measure your risk tolerance is when you're afraid. When you're concerned, when you are negatively emotional. It is not when you're ecstatic, when you're feeling good, when you're elated, when you're feeling all kinds of positive feelings about money, because you are going to change your answers based on how you feel. And we believe, and again, let me just do this. We don't get anything from risk quizzes. They're free. We just give them away. We don't call you. We don't try to sell you anything. It's none of that. This is really easy. You just go to talkingrealmoney.com and click on the risk quiz, and take it every couple of years. Take it regularly just to see how your risk tolerance fluctuates. Doesn't cost anything. Might as well do it. But go take it right now in a market like this, because this is going to give you the best idea of what kind of portfolio you need to build. And Tom, based on people's risk tolerance, how do they know what to put where? In
terms of how much risk and
stocks
less risk?
And bonds. Yeah.
I mean,
this determine all this.
Well, that's the harder part, right? I mean, then it becomes a matter of your need for return, your ability to take risk, and how soon until you need the money. But my number 2 on the control list was, once you've taken the risk quiz, once you've sort of developed that plan, you can control what your stock to bond ratio is. Mm-hmm. That's something that you can do, whether you're doing this on your own, you have an advisor, whatever it is. You can control that. You can't control the prices of those assets, but you can control your asset allocation. Number 3, and this is very important, and is proving important even this year when things have been ugly, not horrible. Be diversified. You can control how much diversification you actually have. Not just the Standard & Poor's 500, not just U.S. stocks, but international stocks, international small stocks, international value stocks. How about emerging markets? Ooh, doesn't that include Russia? All those things should be in your portfolio, but you can make that control. And here's the 4th one, Don, and this is one you have preached for these, I dare say it, 30 plus years?
35, too 35, long.
All these years.
88, 34.
You can control. Here's one easy way for you to make more money. You can control the types of products that you use to invest. If you use low-cost portfolios, low-cost index funds, or exchange-traded funds, well, that's something you can control. And you can do it pretty easily in today's world, whether you're doing it on your own or having someone else do it. So that's another thing you can actually control. And those things are absolutely critical because those are up to you. They have nothing to do with the outside market factors, which will change day to day.
And the trick is, once you do those things, once you've built this right portfolio, then here's the toughest part of the entire equation. the entire process, stop looking. Look at most once a quarter. Ooh, that's hard to do. That is hard.
Yeah.
Look once a quarter, rebalance at least about once a year. Put everything back in order again, which means, for example, right now, it would mean you'd be actually selling some of your bonds, which would make a lot of people happy, and buying some stocks if you were in a rebalance position right now.
But look out, because the bonds are coming on strong. They had a good day yesterday, another good day today. This is very temporary, but they've rebounded already a bit.
You're looking day to day?
I've watched the prices of those, not in my portfolio, but I do watch the prices of all securities because it's my job.
Oh, that's right. He is an investment advisor. I forget sometimes.
I'm not just a pretty face.
I wasn't going to go that far.
Well, I'm going to just toot my own horn then in that case.
I mean, I'm pretty sure this is not a pretty face, but
maybe that has something to do with our video subscription. Just
any other? Yeah, that's probably why we only get like 100 views. But we were talking about this the other day, and Mark Hebner, who's a friend of ours, who does videos for Index Funds Advisors, IFA.
Yeah.
He has videos. He's had them up for, we used to help him make them.
Yeah,
Tom used to be on them.
Yeah, I was.
More than a decade ago. And he's been doing them for a lot longer than we have.
Yes, he has.
And he only gets, after a week or so, he only gets about 150 to 200 viewers. We get about 100 and some odd. So it's what I think it is. I think it's old guys doing videos. I just don't think there's much of a market for old guys doing videos.
So we should get some actors to play us who are much younger and maybe even more attractive to jump in our place.
The following video is based on real people.
You think anybody wakes up in the morning and said, I can't wait to get up and play Tom Cock today? No, I don't think so. So sorry. I just doubt it.
Except Dave.
Yeah, maybe
Dave. And Dave, you know who you are.
You do know who you are.
Most of the video is your fault, Dave.
Oh, God, we're going to go there now?
Dave.
This is the Don McDonald limited employment contract.
Do you know how many Daves there are in America?
That's
Come
true.
on.
That's a very popular name.
Could be.
But there's a lot of
Dave
Daves now.
And Buster.
A lot of popular Daves sitting around going, is he talking about me? Is he talking about me?
Could be David Letterman.
That's true. Could be. Yeah.
Could be. Now I'm having a hard time thinking of any Daves. I just said there were a lot of them.
So now you know which Dave we're talking about.
Do you have anything else you want to add to this advice you just gave?
I've just done enough for right there.
Here's a question that's really timely and fits right in with our conversation.
Absolutely.
Oh, people. We need to talk. And we need to talk. You can call us to do that at 855-935-TALK. Leave your questions there. Those generally get answered on the Friday podcast.
When Don does his questions, boom.
Oh, man, I think I got like 7 or 8 questions in last week. I hope.
Any obscure phone numbers you included?
I did not. And, one of the problems is, I'll tell you what one of the problems is. I edit a lot of these shows on Tuesdays. And Tuesdays, I have an acting class on Monday night. And I have a great teacher, but, man. The class ran till almost midnight last night.
Is his name Dave?
Dave? No, it's not that Dave.
Dave's
anyway, so this question though came in at talkingrealmoney.com. Yes. And so for the reading of the question, I do need to doff my wisdom glasses.
Yes, the wisdom.
Yeah. Wisdom glasses.
Okay.
All right.
Cheaters.
This is the one. All right. Oh my gosh, this question. You love this question.
Good.
I thought I was doing the safe thing by investing in Vanguard's Total Bond Fund, BND. But it went down a little over 5.5% over the past year. What gives? How does a bond fund go down? Isn't the purpose of a bond fund to give you safety in exchange for lower returns? Between inflation and the drop in the fund, I lost about 10% investing in that thing over the past year. I am mad and never want anything to do with a bond again. Am I wrong? I'm going to give him the short answer. Yes.
Yes. Oh, sorry.
You are wrong.
Yeah. Okay, but let's go. I'm trying to find if it really lost 5.5%.
I got BND. Last year for 2021, the total return which includes the
Yep.
income
Yep.
minus the drop. So we're probably talking about a loss in the value of the portfolio of about 3.5%. The total loss was a negative 1.86, including
So
the
when
dividend.
you take the reduction in the value of the securities it holds plus the interest, right? That's the plus side.
And the
It gives you
interest
the
was
return.
about 2. So maybe it's closer to 4 for
And what
2021.
the complaint is, well, wait a minute, I also lost to inflation. Well,
Right.
that's a whole separate can of worms to discuss.
Right. And here's the thing. You may have lost money in your bond fund, but if you were in a fixed income product a totally safe product that provides a little teeny tiny bit of income and no potential loss of principal, you lost money to inflation.
Big time. If depending on which inflation number you want to use. So, yeah, okay. So let's go back. So people always have a tendency to look at that part of my portfolio made a lot of money, that part lost. So I'll sell the part that lost and buy more of the stuff that made it.
Mm-hmm.
And they're mixed up. The bonds, as you correctly point out, should be there for stability. And will they go up and down a little bit from time to time? Sure. It's a basket
do this
of securities.
for me, Tom. Let's define stability, because I think some people read stability as
never going down?
chance of loss.
Is your relationship with your loved ones perfect every single day? Does it ever have any variation? A little bit of variation? Sure it does.
Yeah, but you see, here's what people are used to. They're used to the heady days of the 80s when you could
days of
you could get, double-digit returns on your CDs with no risk of loss. Except banks were failing.
I was making people a lot of money back then, Don. So, no, here's the thing. Okay,
That's
what?
one of Tom's 2 impressions.
No, I can do that's about right, too.
Yeah,
That's
2.
the
Yeah.
point. Here's bonds. Yes, they should be there for stability. Are they perfect all the time? No. Let's just, for equivalence, the loss you mentioned, even if I believe the 5.5, which I do not, because Don just said it wasn't true, but let's just assume it did. It was 5%. In a bad year, stocks can lose how much? 30, 40, even 50%. So they're not equivalent. If you're
thank you. It's relative stability.
Yeah, it's relative stability. If you want to make more money in looking back, then yes, you'd have most of your money in stocks. They have made more money. If you're not willing to accept volatility, you want more bonds. That's the simple trade-off. It is, but not everything is going to go up year after year. Bonds have down years. They may have another down year this year. Who knows? But the down is pretty small down. It's not a big deal.
And there are a couple of things going on here. You, with a bond fund or a bond ETF like BND, which is an exchange traded fund that is made up of, by the way, 18,000 different bonds, 18,000 different bonds with an average duration of about 7 years. So it's a little bit long. That is an intermediate term duration, because they have longer bonds in, they have shorter bonds in, because it's a bond index. Actually, for greater stability, I would suggest something that was a short intermediate bond fund, because a short intermediate bond fund is going to have a duration more like 4.5 to 5 years.
Yeah, okay, 4, yeah.
Which is going to mean smaller losses when bond prices fall. When interest rates rise, bond prices fall. This is what happens. But the other thing that happens is the distributions increase as the fund is buying new bonds. And that is evident in the distributions we've seen. We've seen, like, in June of 2021, the distribution was 13 cents. And in December of 2021, the distribution was 14 cents. So the income starts to slightly rise as the value goes down. Bond funds, even bond funds, are not meant to be short-term vehicles, and they were never intended to be absolutely safe, no, you can't lose any money vehicles, because if you really truly do not want to lose any money at all, then the best you can do with liquidity, and see, remember, we've got to talk about liquidity too, because if you put it in a CD, and you want to take it out before the year or 2 years is out, whatever that is, you are going to lose money. You're going to give back some of your interest. In other words, that's a loss. So right now, the high yield savings rate is, I just haven't updated it in a while.
60 basis points, 70 basis points?
It hasn't moved at all, between 50 and 65 basis points.
So
right about 0.5%.
Yeah, 0.5%. Okay, just
now,
to finish
after inflation,
the thought, you're getting killed. And just to finish the thought, because what you're saying there I think is important, but I also want to make sure people understand it in another way. Bond funds, bond ETFs are buying new bonds at higher interest rates. So they're getting new securities in. And I think up until about last week, Don, the 10-year note was approaching 2. So you're going to see, what you're going to see is the bonds that are in there mature. They're buying new ones at higher rates. That will, again, as you point out, increase distributions to some extent, and just the yield will go up as prices have gone down. They are sort of linked at the hip, if you will. So again, small decrease. Yeah. Okay. I'm okay with that. Mostly there for stability in the portfolio. Yeah, pretty much, even in an off year like 2021.
Thanks for your question. We appreciate it. And again, if this concerns you, scares you, worries you, then this is a lesson everybody needs to learn. There's nothing in which you can invest and get high returns with no risk. Nothing, not one thing. No matter what people will tell you, they will lie because they know that's what you want. That is not necessarily that is not even at all what you can get. If you want no risk, 0.5 percentage point before inflation, before taxes. Because remember, you also have to pay income tax on that. So
your partner, the U.S. government.
Thank you all for joining us for this edition of Talking Real Money. If you have questions, you can call us with them at 855-935-TALK. You can send them in at talkingrealmoney.com. And we also offer a really, really, really cool service that many of you have taken advantage of. And we've never gotten a single complaint that somebody got a high pressure sales pitch or was felt like they were being pushed to do something. Not one. Have we ever gotten one? No, I don't think we have. So go to vestory.com, vestory.com, and sign up for an appointment with one of our advisors. They will help you for a little while, for free, for nothing. We will not manage your money for free. Bad idea. We make no money. We go broke. But if you like the way we manage money, sure, we'd love to welcome you as one of our clients. So go to vestory.com, sign up, vestory.com. Tom is calling because his glitched out, and I wish he wouldn't call right in the middle of this, but I'm going to say bye. Bye.
We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Capital, a fee-only registered investment advisor. Thanks for listening, and please visit talkingrealmoney.com for more information and disclosures. Are we done now?